Joining us to talk more about all of these economic and market cross currents is Hugh Johnson. He is Chairman and Chief Investment Officer at Hugh Johnson Advisors. Good to see you again, Hugh. Welcome.
Nice to be with you, Susie.
The key question for the market right now, it seems to me anyway, is now that we've pushed up to 3%, can stocks continue to go higher if interest rates continue to go higher?
You know, it's not at all unusual in financial market history for the stock market to be going up and interest rates going up at the same time. It's only when interest rates get to a level that presents problems or looks like it's going to kill off, in this case, say automobile sales and housing, which have been very strong, or kill off the economy, that the stock market really runs into problems. So it serves as a drag on stocks, but it doesn't kill off the bull market until we get to a much higher level. Thankfully, we started from a low level. That's the good news. And the second piece of good news is that if you take a look at the performance of the financial markets, the message of the financial markets is that interest rates, although they've gone up a lot, have not reached a level that are going to kill off this economic recovery. So everything's fine right now, but you've got to watch very, very carefully.
And I guess you have to watch very carefully what's going on in the bond market. Now, today, Bill Gross, who's the head of PIMCO, the world's largest bond fund, is out with his September report, and he's saying that the safe place for investors to put their money right now is not in stocks, but in bonds, shorter-term bonds. What do you think of that?
I couldn't disagree more. I think that what we see going on, you know that the return from stocks more recently has been positive. The return from bonds has been negative. I think that's an ongoing process. I think we still have further to go in the current cycle. If we have further to go in the current cycle, as I suggest we do, and that's through 2013 and 2014, the return from stocks, owning stocks, is going to be significantly higher than owning any fixed income securities, whether they're long-term or they're short-term. And put some numbers on it, I think the returns are going to be closer to, let's say, 9.5% on the stock market and down as low as 2.5% from the fixed income market. So people should not back away from the equity markets. That's where the returns are going to be the best. I disagree with them.
So where are you putting your money? What stocks would you be buying right now, Hugh?
Well, right now we're working with the stuff that's really been working. Bull market sectors primarily. First of all, consumer cyclicals right at the top of the list, financials, industrials, and healthcare. Those are the four sectors of the market that not only look good on a valuation basis, but also have been performing well. So we've been buying companies like in the consumer cyclical area, Johnson Controls, in the healthcare area, a company like Mylan, Industrials, United Technology, and First Republic Bank, which is a financial company, a bank company. So those are the kinds of things we're buying. And again, we're maintaining a fairly meaningful exposure to the stock market because, again, that's where we think the returns are going to be the best.
Hugh, just a little bit of time left. I want to ask you about this big jobs report coming out tomorrow, what it would mean for stocks, bonds, and the Fed. Quick answer.
Well, the quick answer is that based on the ADP report today, it's first of all tough to forecast employment, but it looks to me like the numbers tomorrow are going to show that we grew more jobs than is the consensus expectation. I think what that's going to do is going to be fairly good for the stock market. It's going to be negative for the bond market. Interest rates might edge up a little bit further. It's pretty much going to guarantee that the Federal Reserve is going to announce they were going to reduce their stimulus starting at the end of September. But again, I think it's positive for stocks, negative for bonds, and it's good for the ongoing cycle. So that's what I think is going to be the outcome.
Thanks so much, Hugh. Always great to see you. Hugh Johnson, Chairman and Chief Investment Officer of Hugh Johnson Advisors.